Hey everybody, welcome back to the Financial Freedom Show. My name is Rob Berger. Today we're going to talk about Robo-Advisors and specifically two quote-unquote free Robo-Advisors that aren't actually as free as you might think. I was doing some research to identify what I think are sort of the best Robo-Advisors, the ones that I might recommend. I actually wrote an article about it. I'll link to it below this video, but today I don't want to actually talk about the 5 top robo-advisors that I identified. I want to talk about 2 that didn't make the list. And the point here is not to pick on these 2 robo-advisors. These are not horrible automated investing platforms, but they do market themselves as free, meaning they don't charge a management fee. You do pay the fees of the underlying ETFs. They don't charge a management fee, but the problem is when you look under the hood, you see that there are other costs associated with both of these platforms, and it's the kind of thing that you may miss if you just look at the headline and ignore the details. And so I want to kind of walk through that today. What are the 2? Well, one is SoFi, automated investing, and the other is Schwab, intelligent portfolios. Those are the 2. Again, I'm not saying these are horrible robo-advisors, but they're not as free as you might think. And that's really kind of what I want to underscore today. So let's take a quick look at them. Here is the first one. This is Schwab. And if we dive down a little deeper, we can actually look at their portfolios here. So we'll start with their most aggressive. And if we review the results, these are the asset allocation at a high level. And you'll notice this is the problem right here. Whoops, I guess I can't highlight it, but it's 6% in cash. You have no choice. If you pick the aggressive growth portfolio, remember, this is the most aggressive. You must put 6% in cash, and that's how Schwab makes its money, because you're going to earn basically a 0% return on cash, at least in today's environment. And that's effectively how Schwab is making some money. I would much prefer that they allow us to have a portfolio with no cash and just charge us a fee. I mean, at least then the cost to us would be transparent. Trying to figure out the cost to us of forcing us to put 6% in cash is a lot more difficult. Just tell us what the fee is and charge us. And it actually gets worse. This is the aggressive growth portfolio. At moderate growth, you're forced to put 9% in cash. And if you get even more conservative, let's say moderately conservative, boy, now you're up to 14% in cash. And if you go conservative, it jumps all the way up to almost a quarter, 25%, it's 23% in cash. And so that's the problem I have with Schwab intelligent portfolios. I don't like being forced to put money in cash or to put my investments in so much cash. There is a cost to doing so. That's going to be a drag on the returns of the portfolio. But as an investor, it's hard to kind of put a number on that. Whereas if they just charged us, let's say, 25 basis points, which is something, say, a Wealthfront or a Betterment does, then at least we have the costs, we see them, we can evaluate them. So I would prefer that Schwab did it that way. But the real point is we shouldn't view Schwab as free, because it's not. There's a cost to forcing us to put our money in cash. Okay, that's Schwab. Now let's take a look at SoFi. SoFi is, I think, even more difficult to justify, honestly, in my view. So let's take a quick look at it. And I'm actually in my SoFi account. I don't have any money with SoFi, and the numbers here are just made up. But they did an analysis based on some questions, and they've recommended this 100% stock portfolio for me. Fine. It's the details. If we click the details, and I don't know how well this is showing up, but it lists how they're going to divide up my money if I were to invest this way. And you'll notice they've got 3 Vanguard funds here at the bottom. But look at this. They're actually promoting their own SoFi branded ETFs as part of this quote unquote free portfolio. And when you look at this first one, SoFi Select 500 ETF, you might think to yourself, okay, Rob, what's the big deal? Fine, I'm sure it's a low-cost S&P 500 index fund, so they don't use Vanguards. Big deal. Well, not so fast. If we dive into the details, we notice that the description doesn't say it tracks the S&P 500 index. It says it's composed of the 500 largest publicly traded U.S. companies. And then SoFi weights each company based on 3 key growth signals. That doesn't sound like an S&P 500 index fund. And you'll notice they don't give us the expense ratio. Right here it says expense ratio, and there's nothing after it. There's just this link to a prospectus. All right, well, I like the details. So this is the prospectus, and it covers actually a number of SoFi funds, but here's the Select 500 ETF. So the first thing we see is 19 basis points. So, is that the end of the world? No, but we all know we can get a Vanguard or a Fidelity or an iShares S&P 500 index fund for a couple of basis points. Why would we pay 19? That's the first thing. The second thing is we can see that indeed it does not track the S&P 500 index. It tracks this SoFi proprietary index that they call this, Selective SoFi US 500 Growth Index. So it's not even an S&P 500 index fund. Now, I did an overlap analysis between SPY, the basic S&P 500 index fund, and SoFi's fund, and there's a large overlap. So, these two funds are similar, but there's still a significant difference as well. And in fact, I backtested these two funds. Unfortunately, because SoFi's fund is so new, we only get a little over 2 years worth of data. But when we look at the results, actually, SoFi their fund has actually outperformed by just a little bit. Again, it's only 2 years, and that factors in the 19 basis point fee that SoFi charges. But when we look at the year-to-year results, we can see that their outperformance all came in the first year of the fund. SoFi is the blue fund. Last year, they actually underperformed, and this year they're underperforming as well. Of course, both funds are down, but SoFi's is down more. Does this mean that SoFi fund is a bad fund? No, but we have very little history on it, and it costs several times more than a typical S&P 500 index fund. And if we go back to SoFi Invest, we see that they also have a second fund, SoFi Next 500, and we can also look at its expense ratio. I believe it's the same, 19 basis points. So the real takeaway for me is that SoFi isn't free. When you invest with their automated investing service, you're going to put, depending on the portfolio that you choose and that they recommend for you, you're going to have some money in a SoFi ETF that's going to be, I think, notably more expensive than sort of a typical S&P 500 index fund, for example, and it's not even going to track that index. Again, it doesn't make SoFi a horrible option for an automated investing platform, but it does make me wish they would just use standard, basic, funds that track well-known index funds that have been in existence for a very long time and just charge us a management fee. I think the costs would be much more transparent, and we would have funds that track well-known index funds. So again, I'm not here to say that Schwab and SoFi are terrible choices, but I did want to bring to your attention that free doesn't always really mean free, and it's really important to look under the hood and understand how any automated investment service is making its money and what kind of portfolio they're going to put you into. Listen, if you have any questions, leave them in the comments below. And as always, and until next time, remember, the best thing money can buy is financial freedom.